is something all of you, to a large extent, are familiar with. Without wasting more time, when a company wants to embark on, or when a company wants to incur capital expenditure, it is not sufficient for the company to just commit the hidden financial resources into executing a project. So it is important that the project will be evaluated in order to ensure that there is optimal capital allocation. And not only that, the management must ensure that the project is capable of the value of the company for the purpose of maximizing shareholders' owners' worth. Therefore, what do you understand by capital budgeting? Capital budgeting represents the process by which an organization commits its funds into long-term projects. You have the material, it's the same material on risk and uncertainty. Congress, it's the same material on risk and uncertainty. Open it. So, like I said, capital budgeting represents the process by which an organization commits its funds into long-term projects. When you talk about long-term projects, they are projects that will last for more than 12 months, okay? Capital budgeting are projects that will last for more than 12 months. Therefore, what are the examples of capital expenditure? Construction of roads, dams, refineries, okay, bridges, office building, even owner-occupier building, okay? So any project that will last for more than 12 months or more than 1 year is what is known as capital budgeting. At times, you can call it capital expenditure, capital investment, or investment appraisal. Is the same thing. So it is expected that management will embark on projects that will maximize the value of the business, which will invariably enhance the owner's equity value using relevant investment appraisal technique like Slim, please mute. Sorry about that. It's the distraction from one of you. So that's basically the introduction to capital budgeting. So manage investment opportunity that will increase the value of the business and which will invariably maximize the shareholders' equity value. Okay, because the limited scarce financial resources is never sufficient, and therefore management must ensure that there is optimal allocation of resources. Okay, now what are the procedures involved in capital budgeting decision? There are basically about 5 or 6 procedures involved in capital budgeting decision. One is the identification of investment opportunity. Okay, identification is evaluation of projects. Then number 3 is authorization as well as approval of projects. Number 4 is developing and executing of projects. Number 5 is controlling, monitoring and controlling of projects. Then number 6 is post-completion investigation. All of these are the procedures that needs to be undertaken when carrying out investing decision. You can just read through the meaning of each procedures because I want to, I don't want us to go through that. Okay, talking about the identification of viable or identification of investment opportunity or each procedure. For example, when you talk about identification of investment opportunity, there are some departments within an organization that are responsible for scanning the business environment to be able to identify investable opportunity. For example, marketing or R&D department or business service units within the organization. They may be the one that will look around the business environment to be able to identify or to spot which investable opportunity are available. All right. So there are a whole lot of activity that we go into doing that, but I don't want to go into details because of a limiting factor that we have. However, once the opportunity has been spotted or has been identified, there will be through memo or a meeting to convey the message to the management and just to give an update on their findings. Then thereafter, the finance departments are represented by the finance director or finance manager, finance supervisor, or chief financial officer, depending on the structure or on the size of the organization. We then be required to go ahead and evaluate the project, and that is where you have the responsibility as an accountant. Okay, whether you are a financial accountant, finance analyst, project accountant, whatever you have your designation, provided you are within the same unit of, I mean, finance department. Okay, I think network is going to mess up tonight. I don't know. Let me reshare my screen again. This is very strange on Monday. All right, let's continue. So let's just go straight to the point that network is frustrating. Okay. Yes, the major work that we have under this topic is to explain the methods of project evaluation. Like I mentioned earlier on, when you want to execute a project, it is not sufficient to just commit the limited scarce financial resources into undertaking the project. It is important that the project will be evaluated in order to ensure that the value of the company will increase the worth of the owners. And that is why it is expected that you need to learn about the methods of appraising projects. How do you determine what are the methods that can be used to ascertain the financial viability of a project? Okay, so basically there are two methods of appraising a project. One is the discounted cash flow method, and two is the non-discounted cash flow method. Okay, so the discounted cash flow method is a method that considers timing of cash flow and the time value of money. So the time value of money connotes that today is worth more than the value of 1 naira of tomorrow due to price level changes, that is inflation, and then the investor's preference to have their benefits now rather than keeping it into the future. All right, that is the what time value of money connotes. Okay, now under the discounted cash flow method, there are several techniques that can be used to appraise a project, but as far as your scope is concerned, I will limit it to the discounted cash flow method. One is the net present value. Okay, one is the net present value, Then 2 is the internal rate of return. Then 3, discounted payback period. So those are the 3 methods under the discounted cash flow method. There are more than that, but as far as performance management is concerned, those are the 3 I will give to you. When you get to professional level, when you are going to be having a strategic financial management, there are other methods like modified internal rate of return, project duration, okay, adjusted present value, profitability index, benefit cost ratio. All these methods are part of discounted cash flow. Okay, but as far as your syllabus is concerned, you are expected to learn about the net present value, internal rate of return, and then the discounted cash flow method. Then under the non-discounted cash flow method, of course, the non-discounted cash flow method represents a method that does not consider, okay, timing of cash flow and the time value of money. It is also known as a traditional method of investment appraisal. Okay, so the techniques under the non-discounted cash flow method include the payback period as well as the accounting rate of return. So all of these 5 techniques, we are going to explain them one after the other. Okay. So what do you understand by the net present value? The net present value is a technique, is one of the techniques under the discounted cash flow method. Okay, and it represents the difference between the present value of cash inflow and present value of cash outflow in capital investments. The net present value is considered to be the overall investment appraisal techniques. Of all the investment appraisal techniques, NPV is adjudged to be the best because of the fact that it is consistent. It's a technique that is consistent with the shareholders' wealth maximization objective, because it is believed that a positive NPV will increase the value of the company, and which will invariably maximize the wealth of the owners. All right. So that is why NPV is considered to be the overall of all investment appraisal techniques. Therefore, how do you compute the net present value? The net present value can be computed using formula, or you can use formula method. Whichever one you use, you are going to get the same answer. Say, for example, you want to calculate NPV using formula. Therefore, I would then say net present value equal to, like we said NPV is the difference between the present value of cash inflow, okay, and the present value of cash outflow in capital investment. Therefore, when you want to determine the present value of cash inflow using formula, then you can say irregular. Say, for example, the cash inflow is irregular. You have different cash inflow for each year. Therefore, you pick the cash inflow of year 1. You divide it with discount factor of year 1, okay, plus cash inflow of year 2 divided by the discount factor, okay, excuse me, okay, what's wrong with you? Okay, discount factor of year 2 plus cash inflow of the final year divided by discount factor of the final year. So this will give the present value of cash inflow minus the present value of cash outflow represented by CO. All right. So when you summarize, when you add up the present value of cash inflow, you less it from the present value of cash outflow. The difference is what is called the net present value. That will give you the net present value. So if you want to use formula, that's the way you are supposed to calculate your NPV. However, when you want to use the tabular method, of course, all of you are familiar with this format. We have solved it. We have solved several questions using this particular format. So of course, you create a column. The first column will be for the year. That's why you're depending on the useful life of the project. Then you can also create a column for the item, the description of the items. Okay. Then you create a column for cash flow, discount factor, then the present value. So to get your NPV, you need to first of all add up the present value of cash inflow. You add it up. Then you now less the present value of cash outflow to get your NPV. It is important that you must first thing first add up the positive present value before you less the negative present value. Otherwise, you are going to have a wrong interpretation. If you start from the negative, or if you start from the cash outflow, for example, to get your NPV, you may have a wrong interpretation. And that's why it is important. You have to add up first the positive present value, less the negative present value to have your NPV. So if that is the case, then what's the decision rule? What's the decision rule for NPV? For independent projects, okay? For independent projects, accept if NPV is positive, okay? Accept if NPV is positive, but if negative, you reject the NPV. But where there is zero NPV, we can either accept or reject the project depending on whether, depending on other qualitative factors, okay? That is for independent projects. Then B, for mutually exclusive projects, you accept any project with a higher positive NPV. Okay, accept any project with a higher positive NPV. Okay, so that is the decision rule on NPV. Therefore, what do you understand by independent project or mutually exclusive project? So independent projects is a standalone project that may be accepted or rejected based on its own merits. Okay, I repeat, independent projects is a standalone project that may be accepted or rejected based on its own merits, which means that if the project is has a positive NPV, for example, it will be accepted, but if negative NPV, it will be rejected. So it's a singular project. Independent project is a singular project. That's why we say it is a standalone project. All right. But if that standalone project is financially viable, you accept it. But if not, you reject. Then mutually exclusive projects are competing projects in which the acceptance of one will preclude the acceptance of the other. What that simply means is that project A and B are mutually exclusive. The acceptance of project A will mean the rejection of project B. If you accept project B, you are going to reject project A. So mutually exclusive projects are projects that cannot be accepted together. That's an interpretation. So the projects that cannot be accepted together are mutually exclusive. So on that basis, any project that has a higher positive NPV will be selected at the end of the day. So that is mutually exclusive projects. So if you, of course, like I said earlier on, we have been calculating NPV for a while now. So you know the formula for discount factor. In case you don't know, that's the formula for discount factor. All right. Then in case you have to determine, you want to calculate cash flow to perpetuity. Okay, when you want to calculate present value to perpetuity, calculate present value to perpetuity. So it could be just your cash flow divided by the cost of capital. That's the cash flow to perpetuity. Or first thing first, you calculate the discount factor to perpetuity, which is 1 divided by the cost of capital. Then you now multiply with the cash flow. It will give you the present value to perpetuity, you get the same answer, or just use this formula straight and move on. All right. Again, if you want to calculate annuity factor, generally annuity factor is used when you have a constant cash inflow or cumulative discount factor, we call it. Say, for example, you are given a project that has 3 years life, and you are told that this project will generate a cash flow of 100,000 naira. Okay, so meaning that this 100,000 will be for year one, 100,000 naira for year two, 100,000 naira for year three, because the cash inflow is constant at 100,000. So instead of you to be doing year one, year two, year three, 100,000, 100,000, 100,000, it's a waste of time. Just calculate annuity factor, then multiply with 100,000. So it will give you the present value for the 3 years. So that will be faster. So that is the formula for calculating annuity factor. Okay. So that's this. So you can read about the advantages and disadvantages of NPV. At this level, at this case level, examiner can ask you advantages and disadvantages of NPV. Please do well to go through the material and have the understanding. They are very straightforward, okay? And they are simple to understand. So go through it. Then let's go to internal rate of return. Let's go to internal rate of return. The internal rate of return is also known as break-even rates, yield to maturity, market discount rates. Okay, the internal rate of return represents NPV of future cash flows to zero. Okay, the rate that equates the NPV of the future cash flow to zero is what internal rate of return is. What do you mean by the rate that equates NPV to zero? Generally, when you want to compute internal rate of return, you are expected to assume two discount rates that will produce two opposing NPV. One discount rate will give a positive NPV, then another discount rate will give a negative NPV. So any discount rate that you assume and produce a zero NPV, that discount rate is your internal rate of return. And that is why we usually say that internal rate of return is the rate that equates the NPV of future expected cash flows to zero. Okay, so like I said, whenever you want to compute the internal rate of return, there are three stages, there are three procedures that you are supposed to carry out. The first procedure is to assume two discount rates. You don't use the company's cost of capital whenever you want to compute internal rate of return. You are the one that will assume two discount rate, and that is one of the disadvantages of IRR because it is subjective. So you are the one that will assume two discount rate to calculate the internal rate of return. So the first step is to assume two discount rates that will produce two opposing NPV. The first discount rate will give you a positive NPV, and the other discount rate will give you a negative NPV. Then you proceed to calculating the internal rate of return using internal rate of return formula. Okay, A is the lower discount. You know, you assume two discounts. Say, for example, you assume 5%. You also assume 10% to calculate the internal rate of return. Therefore, 5% is the lower discount rate. That's the lower discount rate you are going to put here as A. 10% is the higher discount rate. That is the B. So you are going to use the 5% to calculate NPV. So whatever you have, that's the NPV of the lower discount rates divided by the NPV of the lower discount rates plus the NPV of higher discount rates. Ordinarily, the original formula for IRR, okay, the original formula for IRR is lower discount rate plus net present value of the lower discount rate over net present value of the lower discount rate minus higher discount rates, okay, multiplied by higher discount rate minus the lower discount rates. So generally, the denominator is minus NPV of the lower minus the NPV of the higher. So it is expected, of course, since NPV of the higher is always minus, therefore minus times minus will then turn to positive. And that's why you usually see the sign in this formula as positive instead of negative. because you are expected to multiply, minus multiply by minus will give you positive, return to positive. That is why we don't use minus as the denominator. It's primary school for you to be putting NP of A minus NP of B. So you should know already that it return to positive. Okay, so that is for except if IRR is greater than the company's cost of capital. Okay, accept if IRR is greater than the company's cost of capital, then you reject if it is lower than the company's cost of capital. That is for independent projects. But for mutually exclusive projects, you accept any project with a higher IRR provided it is greater than the company's cost of capital. Okay, for mutually exclusive projects, accept any project with a higher IRR, provided it is greater than the company's cost of capital. So that is what you need to do as far as internal rate of return is concerned. Again, there are advantages and disadvantages of internal rate of return. Please do well to go through them. Okay. Then the next thing we are going to discuss is the areas of conflicts between net present value and then the internal rate of return. That's the next scope that we need to discuss. What do you mean by this? Where there are mutually exclusive projects, the decision of NPV may be competing with the decision of internal rate of return, such that NPV may favor a particular project, and on the other hand, the internal rate of return may suggest another project. So this is an apparent conflict that needs to be resolved. Therefore, what is causing the conflicts? What are the causes? Or what are the reasons for conflict between NPV and internal rate of return criterion? So there are three major reasons that is usually causing the conflicts between NPV and then the internal rate of return. Let me use an hypothetical figures to explain this. Okay, say for example, you have project A, you also have project B. All right. Let me put discount factor here, say at 10%. Now, let's say the initial outlay of project A is 500 million. Project B is 800 million. Of course, at year 0, discount factor is usually 1. All right. Therefore, the cash inflow for year 1, for example, say is 300 million. Year 2, 200. Year 3, 120. Year 4, dash. Year 5, dash. Then for project B, year 1 is 100 million. Year 2 is 120 million. Year 3 is 200. Year 4 is 300. Now let's say it's 250 for simplicity. Then year 5 is 300. So these are the cash flows of project B. You will know that using 10%, discount factor of year 1 is 0.909, okay, 0.826, 0.751,
Sorry, is it just me? I can't hear anything again.
I can't hear anything too.
His network has locked him out.
Sorry, I'm back. You have to manage tonight. This is very strange on Monday. Oh yeah, let's continue. So I was trying to explain to you, yes, the first reasons or causes of different or conflict between NPV and internal rate of return is when there is significant difference in the amount of capital outlay. So when there is, for example, in these hypothetical figures between project A and B, you will notice that the initial outlay of project A is 500 million, while that of project B is 800 million. As a result, because there's a significance between the two, between the capital outlay between the two projects, then in that case, that will make the decision of NPV to be different to the decision of internal rate of return. Then the second reason or causes is difference in the patterns of cash inflow. When there is difference in the pattern of cash inflow, when you look at, what do I mean by that? When you look at project A, you will notice that the cash inflow of project A is higher at the earlier part of the project. In year one, you have 300 million. Year two, 200 million. Year three, 120 million. So in the earlier part, in year one, for example, project A has a huge cash inflow relative to project B. You see that project B has 100 million in the year one, but in the final year, project B started having higher cash inflow. So any project that has a huge cash inflow at the earlier part of the project may be favors over the other. Because when you look at the discount factor at the earlier part, say for example in year one, discount factor is 0.909 at 10%. So you see that the project that has a huge cash inflow in year one, for example, project A, 300 million multiplied by 0.9, that's over 200 million. Relative to project B, that has a lower cash inflow of 100 million. Okay, so when there's a pattern, when there's a difference in the pattern of the cash inflow, then that may cause a conflict between the decision of NPV as well as the internal rate of return. Then the third reason for conflict is when there's a difference in project sizes or the useful life of the project. Okay, what do I mean by that? When you look at project A, you will notice that project A has 3 years useful life, but project B has 5 years useful life. Example, has opportunity of an additional 2 years to recover or to generate additional cash inflow. So as a result, project B may be favored over project A, and then the decision of NPV may be conflicting with the decision of internal rate of return. So these are some of the reasons of conflicts between the decision of NPV and then the internal rate of return. So examiner can ask you, how do you resolve the conflicts? How do you resolve the conflicts? So whenever there is a conflict between NPV and other techniques, including internal rate of return, the decision should always be based on the net present value. Why? Because the NPV is a technique that is consistent with the shareholders' wealth maximization objective. It is believed that a positive NPV will increase the value of the company and which will invariably maximize the wealth of the owners. And that is why the NPV criterion is considered to be the best of all investment appraisal techniques. Okay, so whenever there's a conflict between NPV and any other techniques, your decision at all time should be based on net present value, because NPV criterion is more reliable relative to internal rate of return especially in ranking mutually exclusive projects. So that is, so far we have discussed the techniques under discounted cash flow method, except that we have not discussed discounted payback period. So I want us to explain payback period before I will tell you what you need to do under the discounted payback period. So let's go to non-discounted cash flow method. Under the non-discounted cash flow method, I told you about the two techniques, which is payback period and then the accounting rate of return. So what do you mean by payback period? So the payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. Okay, so payback period is a measure of liquidity, unlike accounting rate of return that measures profitability. So, and at all time, whenever you want to compute or you want to determine the payback period of a project, so you are expected to use cash flow. Okay, you have to use cash flow. So meaning that if accounting profit or accounting information is given to you, you must convert it to cash flow before you compute the payback period. Of all investment appraisal techniques, it's only an accounting rate of return that makes use of accounting information. Every other techniques, they make use of a cash flow. So, no, how quick, how soon can they recover the amount invested in a project? Say, for example, you have invested 100 million naira. You have invested 100 million naira in a project. So management wants to know how soon can they recover this amount that they have invested, taking into consideration the cash inflow that the project will generate. So they want to know how long will it take them, how long will it take the project to recoup the amount they have invested. So that is payback period. Again, please read about the advantages and disadvantages of the payback period. They are very simple. So how do you calculate payback period? There are two ways in which you can calculate payback period, depending on the nature of the cash inflow. For example, where you have constant cash inflow, where there is constant cash inflow, payback period will be computed as the ratio of cash outflow to constant cash inflow. What do I mean by that? For example, if you are told that a project has 3 years life, the useful life, if you are given a useful life of a project, okay, to be 3 years, and you are so told that this project will generate cash flow, the project will generate cash flow of, say, for example, 100,000 naira per annum, 100,000 naira per annum. Okay. And then the initial outlay given for the project is 200,000 naira. Okay. The initial outlay given for the project is 200,000 naira. Let me rewrite that. Okay, that's the initial outlay. So these are the information you have in the question. The useful life of the project is 3 years. The cash inflow that the project will generate for the next 3 years is 100,000 naira per annum. Then initial outlay is 200,000. As you can see, the cash inflow that the project will generate of 100,000 naira is constant. Year 1 is 100,000, year 2 is 100,000, year 3 is 100,000. So that's a constant cash inflow. In that case, if I want to calculate my payback period, I don't need to come and be using the table. So since my cash flow is constant, cash inflow is constant. So all I need to do is to use this formula. So payback period will then be cash outflow divided by the constant cash inflow. In this case, if I want using this, my hypothetical numbers, I would then say payback period is equal to the constant cash outflow. I mean, the cash outflow is 200,000 divided by the constant cash inflow of 100,000. So, of course, at all time, your payback period must be expressed in years. So this means that the project will pay back within 2 years. Okay, the project will pay back within 2 years. So that's the interpretation. You calculate your payback period as cash outflow divided by constant cash inflow. But where you are given irregular cash inflow, okay, irregular cash inflow are cash inflow that are not constant, that are different year on year. For example, in this table, so whenever you have non-constant or irregular cash inflow, you are supposed to use a tabular method. You are supposed to use a table. This is the format. You are supposed to use a table to compute your payback period. All right. The first column of the table is number of years. The description of the item, say balance. Therefore, say for example, in these hypothetical numbers, the initial outlay of the project is 100,000. In year 0, it's still the same 100,000. So we have been given cash inflow of 40,000 for year 1, cash inflow of 70,000 for year 2, cash inflow of 30,000 naira for year 3. So now I want to calculate my payback period. So these are the information that will generally be given to you. So you are the one that will now extend it to include the cumulative balance. Okay. Therefore, I want to calculate my payback period. I will now carry my calculator. 100,000 naira minus 40,000 naira cash flow in year 1. It will give me balance of 60,000 at the end of year 1. Okay, it means that I've recouped 40,000 naira in year 1. So I have a balance of 60,000 naira to recover from this project. I will then move to the following year. Year 2 cash inflow is 70,000. However, where you get to a point where the outstanding balance is lower than the next cash inflow, you have to put a dash and compute your payback period. In this case, I will need to ask myself, how many years have I recovered? I've recovered for only year 1. I've recovered 40,000 naira for year 1. So that's why you are seeing 1 there. Then plus the outstanding balance of 60,000 divided by the next cash inflow of 70,000. So put it in your calculator, 60 over 70, that is 0.86. Then plus 1 will give us 1.86, which that this project will pay back within 2 years. It means that the project will pay back within 2 years. So this is how to calculate payback period. Therefore, what is the decision rule for payback period? What's the decision rule for payback period? So for independent projects, accept if payback period is lower than or equal to the management intended payback period. Okay, accept if payback is lower than or equal to the management intended payback period. Number B, for mutually
Am I the only one? I can't hear anything.
Okay.
You're
We
not the
don't
only
interact
one. He has not logged in.
with network. Please.
Recording in progress.
Sorry. It's what it is. We just have to manage tonight's class like that. So let's continue, please. Yes. So we are done with payback period. Let's go to accounting rate of return. Therefore, what do you understand by accounting rate of return? The accounting rate of return is a technique that relies heavily on the use of accounting information as shown in the statement of in the financial statement of a company. Okay, it is also known as return on investments or return on capital employed. The accounting rate of return is a measure of profitability, unlike payback period, which is a measure of liquidity. Because whenever you want to compute accounting rate of return, profit or loss, all right, but not cash flow, which means that if you are asked to calculate accounting rate of return and you are given cash flows, you are expected to convert the cash flows to accounting profit or loss before computing your accounting rate of return. Okay. Now, how do you compute accounting rate of return? Whenever you want to compute accounting rate of return, you need to go and do some adjustment. You need to make some workings. The first working you are supposed to calculate, you are supposed to carry out is the depreciation. Okay, is the depreciation. So how do you then compute depreciation? The depreciation, like I said, the first working will be to compute depreciation, annual depreciation. And you know depreciation is the cost of the project minus the scrap value divided by the useful life of the project. Okay, this will give you the annual depreciation because examiner will not give it to you. In most cases, you'll be the one, whenever you are asked to calculate accounting rate of return, it's one of the adjustments that you need to first make before you compute the ARR. Then the second working that you are going to do is to calculate average annual profits. You need to calculate average annual profits. This average annual profit will depend on whether you are given a cash flow or you are given accounting profit or loss. In most cases, if examiner wants you to calculate accounting rate of return, you are going to be given cash flow, not accounting profit. Because if you are given accounting profits or loss, it will be very straightforward. But you are going to be given a cash flow. So it is expected that we are going to convert the cash flow to accounting profit. Therefore, if I want to calculate average annual profits, I will pick the cash flow for each year. The cash flow for each year minus the depreciation, minus the annual depreciation. Annual cash flows minus annual depreciation will give me annual profit or loss. It will give me annual profit or loss. Then I need to divide it with the useful life. I will then divide it with the useful life of the project. Okay, so cash flow of year one minus depreciation of year one plus cash flow of year two minus depreciation of year two. I will do for all the relevant years. I will total it. That will give me the total profits. This will then be equal to total profits divided by the useful life. Okay, so by the time I divide the total with the useful life, I will have average annual profits. Okay, so this is how to calculate average annual profit. Like I said, when you are calculating accounting rate of return, examiner, in most cases, you are not going to be given accounting profit, but it's accounting profit that you need, but it will not be given to you. You are going to be given cash flow. Therefore, you need to minus depreciation from the cash flow to get your annual profit. Once you have your annual profit, you sum it up, that will give you total profit. You divide it by the useful life, then you are going to have average annual profit. Then the third working that you are going to do is to calculate average investments. So you need to calculate average investments. So the average investment is the cost of the project plus the scrap value is a figure. Okay, the zero is a figure, so you need to include it. All right. So once you do this, of course, you are going to get your average investment. Then, since you have your average investment, you also have your average annual profit. Annual profit divided by average investment. Percentage, because you are calculating rate of return, so it has to be in percentage. So these are the formulas. These are the relevant formulas that you need to compute the accounting rate of return. So what's the decision rule? What's the decision rules for accounting rate of return? For independent projects, accepts. Okay, for independent projects, accepts if the calculated accounting rate of return is higher than or equal to the management predetermined ARR. Then for mutually exclusive projects, accept any project with a higher accounting rate of return, provided it is greater than or equal to the management predetermined ARR. Okay, so that is the decision rule as far as accounting rate of return is concerned. You will notice something that for the non-discounted cash flow method, your calculated figures is benchmarked against the management predetermined figures. So what that means is that, for example, when we had the payback period, I said that we are going to compare your calculated payback period with the management predetermined payback period. Provided your calculated payback period is shorter or equal to the management predetermined payback period, then the project is financially viable. If not, the project will not be undertaken. Then again, for accounting rate of return, the project will be accepted, provided that your calculated ARR is greater than or equal to the management predetermined ARR. So at all time, when you are using the non-discounted cash flow method, you have to benchmark your calculated figures with the management intended figures. All right. So that is that. Now, let's talk about the discounted payback period. You know, the discounted payback period is one of the techniques under the discounted cash flow method. So the discounted payback period is calculated the same way as the normal payback period, except that instead of using the normal cash flows of the project to calculate the payback period, the present value will be used to calculate. So let's talk about relevant cash flows. Let's talk about relevant cash flows. Now, on the day of your exam, if examiner is going to
said on discounted payback period, please.
pardon?
Please, we didn't get what you said on discounted cash payback period, please.
I said the discounted payback period is calculated the same way as the normal payback period, except that the cash flows are discounted to the present value equivalent before computing the payback period. So it's the same decision rule as normal payback period. So it's the same way you are going to calculate it, except that you are supposed to discount the cash flow first before you calculate the payback period. Okay, so let's talk about relevant cash flows. Let's talk about relevant cash flows. On the day of your exam, if you are going to be tested on capital budgeting, especially if you have multiple variables, so it is important that you understand what relevant cash flows is all about, and then how to identify them when you see it in a question, when you see them in a question. Now, generally, relevant cash flows are cash flows of receipt and payments that affects or that are associated with the project under consideration. So they are cash flows that are directly attributable to the project under consideration. So in the determination of financial viability of a project, only relevant cash flows are considered. Only relevant cash flows are considered. Therefore, whenever you want to evaluate a project using whenever you want to evaluate a project, the following items must be critically examined. Okay, the following item must be critically examined. Number one is variable cost. You already know what variable cost is all about. We have done relevant costing, so you are familiar with that. The bottom line is that as far as variable cost is concerned, variable costs are direct costs. And the examples of variable costs include direct material, direct labor, direct expenses, and variable overhead. So whenever you see variable cost in a question, Under capital budgeting, they are relevant and you must consider it. You have to take it. Okay, when you see direct material cost, direct labor cost, direct expenses, or variable overhead, so all of them are relevant cash flows. So you must consider it. You have to take it. Fixed costs. Fixed costs are costs that have no sympathy for activity level, which means that irrespective of number of units produced, the fixed cost will not change. Therefore, provided the fixed cost will not change, it is irrelevant. Okay, the fixed cost is irrelevant except it is incremental in nature. Except the fixed cost is incremental in nature. Now, there are basically three ways examiner can test you on fixed cost. If you are given fixed costs without no additional information, if you are given fixed costs with no additional information, that fixed cost is irrelevant. That's number one. Number two, if you are given a fixed cost and you are told that fixed cost including depreciation, so that fixed cost that include depreciation is also not relevant. However, you must do something. Because you are told that the fixed costs include depreciation. Therefore, you need to go and do working. You need to go and calculate annual depreciation. Once you calculate your annual depreciation, then you less it from that fixed cost that include depreciation. The difference is relevant, is the one you are going to take. Then number three, you may be given fixed costs excluding depreciation. So whenever you are told, examiner told you that whenever you are told in a question that fixed costs exclude depreciation, that fixed cost is relevant. You have to account for it. So those are the three different ways in which examiner can test you on fixed costs, and you must know what to do at the right time. Then, what do you understand by we have incremental, attributable, specific, and then direct fixed costs? Okay, there is incremental, direct, specific, or attributable fixed costs. So whenever you are given direct, incremental, attributable, or specific fixed costs, they are all relevant. Okay, they are relevant. Attributable fixed cost is relevant. Specific fixed cost is relevant. Incremental fixed cost is relevant. Direct fixed cost is also relevant. All of them, they are the same. They are relevant. Okay. But like I said, only that if you are given fixed cost ahead, no further explanation, please ignore that fixed cost because it is not relevant. You have to ignore it. Then the next item will be to discuss depreciation, all the non-cash items like depreciation, amortization, or provision. So when you see them in a question, ignore. They are not relevant. Whenever you see depreciation, amortization, or provision in a question, they are not cash flow. So you have to ignore it. Okay? You have to ignore it because they are irrelevant. Then the next item will be interest. The interest is the compensation for the use of funds for a specific period of time. It is the actual amount charged, okay, on the principal amount by lender. However, the absolute amount of interest is irrelevant. Whenever you see the naira amount, say for example, you are given interest of 10,000 naira. So you're just given interest of 10,000 naira. This interest of 10,000 naira is irrelevant because the cost of capital to be used to discount the future cash flows already include cost of capital. You know, when you get to professional level, you are going to do strategic financial management. Another strategic financial management, there is one topic that is called cost of capital. So you are going to learn about how to estimate cost of capital. So in the calculation of the cost of capital, you need to calculate cost of debt. When calculating that cost of debt, you need to incorporate. You are going to use the interest associated with the debt. Therefore, because the cost of capital, which is the weighted average cost of capital of the company, already included interest. So if you now consider the absolute amount of interest, the naira amount of interest again, it means that you are treating interest twice. That means you are double dipping. That is why whenever you are given this absolute amount of interest in a question, please ignore it. It is not relevant. Okay, it is not relevant because the cost of capital to be used for the project already included the interest. So if you now consider the naira amount or the absolute amount of the interest, it means that you are double dipping. That is, you are treating interest twice. So whenever you see interest in a question, ignore. It is not relevant. Okay, the next item would be to discuss the opportunity costs. Let's talk about opportunity costs. Opportunity cost is the benefit forgone as a result of taking a particular course of action. So when you see opportunity cost in a question, please, you have to consider it. It is relevant. Then the next one we are going to discuss is historical cost or sunk cost. So the sunk cost is a past cost. There are costs that have already been incurred. Therefore, whenever you see some cost in a question or historical costs, please ignore, they are not relevant. Examples of some costs include development costs, market research costs, research and development, okay, market survey, all those examples of cost in a question, please note that they are irrelevant and should be ignored. Then, lastly, let's talk about working capital. Let's talk about working capital. Okay, now the working capital represents the difference between current asset and current liability. So in the determination of relevant cash flows, working capital should be considered. And of course, the working capital should be treated as follows, depending on whether it is a one-off working capital or incremental working capital. Let me explain. Okay, so as far as working capital is concerned, if you are given a one-off working capital, this one-off working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. What do I mean by a one-off working capital? Say, for example, you have a project with 3 years life, okay? The useful life of this project is equal to 3 years. You are now told that the company will incur working capital of, say, for example, 10,000 naira in year 1, 10,000 naira in year 1. For simplicity, 10,000 naira in year 1. So in this case, how am I going to treat this working capital? The rule says that the working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Therefore, if I want to treat this working capital, I have year 0, year 1, year 2, and then year 3. These are the useful life of the relevant years. So I would then say working capital. Remember, this working capital of 10,000 occurs in year 1. So I'm not going to record it in that year 1 because the rule says that it should be treated as cash outflow in the year before the year of occurrence. Because the 10,000 occurs in year 1, I need to treat it as cash outflow in year 0 because year before year 1 is year 0. Then at the end of the useful life, I will recover the working capital. The end of the useful life is year 3. So I will recover it. Minus 10,000 plus 10,000 will give me 0, meaning that I've recovered the working capital. So this is how to treat a one-off working capital. Say, for example, the project has 5 years life, and you are told that the cash flows of the project, the working capital is 10,000 naira, and that 10,000 naira will occur or will be, the company will incur 10,000 naira working capital in year 4. Therefore, since the project has 5 years life, I would then say year 0, year 1, year 2, year 3, year 4, year 5 is the useful life of the project. But in the information given, you are told that this cash flow, the working capital will occur in year 4. Okay, the company incurs working capital of 10,000 naira in The rule says treat it as cash outflow in the year before the year of occurrence. Then at the end of the useful life. In this case, the useful life is this is how to treat. This is how to treat a one-off working capital. Then the second one is incremental working capital. Okay, incremental working capital. How do you treat incremental working capital? The incremental working capital will be treated similar as the one-off working capital, except that only the increment will be considered. Okay, meaning that the incremental working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. But what we are now saying is that, so it is only the increments that you are going to consider when you want to calculate incremental working capital. Say, for example, you are given working capital, okay? For example, you are given a working capital for year 1, year 2, year 3, okay. So I was explaining how to treat incremental working capital. So, like I said, the working capital in year 1, year 2, and year 3 of 1,000, 1,200, and 1,500 are not relevant, are not the one that you are going to use, because you can see that working capital has increased from 1,000 to 1,500. Therefore, first thing first, I need to determine the incremental working capital. So I can then say incremental working capital. The first working capital, which is 1,000, let me give a space. Incremental working capital. So the first working capital of 1,000, you consider it. This 1,000 has increased to 1,200. So the difference of 200. The 1,200 has increased to 1,500, the difference of 300. Therefore, 1,200, then 300 are what you are going to consider. I can say this is total. So 1,000 plus 200 plus 300 will give me 1,500. Okay. Therefore, I need to determine the relevant year if I want to. That is where I'm going to recognize it. So the first cash flow of 1,000 in year 1, the rule says that it should be treated as cash outflow in the year before the year of occurrence. Year before year 1 is year 0. The one of year 2, which is 200 naira, okay, should be treated as cash outflow in the year before year 2, which is year 1. The difference of 300, which occurs in year 3, should be treated as cash outflow in year 2. Then at the end of the useful life, which is year 3, you need to recover the entire working capital. So this is how to treat incremental working capital. This is how to treat incremental working capital. So that is that. So we are done with discussions around the relevant cash flow in capital budgeting. Then let's move to impact of inflation in capital budgeting. So I will not waste time on this. Okay, I will not waste time on this. But what is important is that there are some specific areas under inflation that examiner can ask you. Of course, generally, there are two types of inflation. We have general inflation and a specific inflation, but the examiner cannot be asking you all of that. That is not my, so you can just read them through. You know what is inflation, so you read them through. Let's go straight to the point. Now, for the purpose of inflation, there are two types of cash flows. Okay, there are two types of cash flows. One is money cash flows, then the second one is real cash flow, and this is examinable. This is very, very examinable. Okay, it is examinable. All right, so you have to know them. So money cash flows are cash flows that incorporate the possible effect of inflation. Okay, they are cash flow that incorporate the possible effect of inflation. So money cash flow represent cash flow that they represent inflated cash flow. So the cash flow that already include the possible effect of inflation is what is known as money cash flow. Except you are told in a question that it is real cash flow. All cash flow is assumed to be money cash flow. Okay, all cash flows are assumed to be money cash flow. Then the second one is real cash flow. Real cash flows are cash flows that do not consider the possible effect of inflation. They are cash flow that is stated in today's prices, year zero prices, year one prices, or current value terms. All right. There are cash flow that are stated in current value terms or year one prices, year zero prices. So whenever you are given a cash flow, say for example, you are given a selling price and you are told that selling price of 2,000 naira in year one. So because examiner has mentioned year one, selling price of 2,000 naira in year one, you should know that it's a real cash flow. That's a real cash flow, or you are given a variable cost in current value. So you are given variable cost and examiner mentioned current value or current value terms. So you need nobody to tell you that that is a real cash flow, because real cash flow are cash flows that are stated in today's prices, year one prices or current value terms. So you need to know all of this. So that's basically money cash flow as well as a real cash flow. So consistent with cash flow. Also, there are two types of discount rates in relation to inflation. For the purpose of inflation, there are two types of discount rates or cost of capital or rate of return. So we have money discount rates versus real discount rates. The money discount rates is a discount rate that include the possible effect of inflation. Okay, there are discount rates that include the possible effect of inflation. So the money cost of capital or the money rate of return is used to discount money cash flows. Okay, the money cost of capital is used to discount money cash flows. Okay, except you are told otherwise, you have to assume the cost of capital given to you to be a money cost of a capital. At times, examiner can tell you that cost of capital of 20% in real terms. So once you hear that, then you should know that it's a real cost of capital, not money cost of capital. Then for the real cost of capital is a cost of capital or discount rate or rate of return that does not include the possible effect of inflation. So it's a cost of capital that is stated in real terms. Okay, it's a cost of capital that is stated in real terms. All right. Now, it is important that you know how to calculate money cost of capital or real cost of capital in a question. Generally, whenever you want to determine money cost of capital, you are supposed to use, whenever you want to determine cost of capital in relation to, for the purpose of inflation, you are expected to use Ivan-Fisher effect formula, okay, to generate your cost of capital. According to Professor Ivan Fisher, the formula for incorporating inflation is 1 plus money cost of capital equal to 1 plus real cost of capital multiplied by 1 plus general inflation rate. So this is the original formula from Professor Ivan Fisher. All right, so it is this same formula that you are going to use to calculate money cost of capital, real cost of capital, or even general inflation rates. So if you want to calculate money cost of capital, that is M. M is the money cost of capital, R is the real cost of capital, I is the general inflation rate. So for the purpose of investment appraisal, if you want to calculate money cost of capital using this Ivan Fisher effect formula, then of course, all you need to do is to make M the subject of the formula. Therefore, the one that is standing behind M will go to the other side. And that's why you are seeing that M equal to 1 plus R multiplied by 1 plus general inflation or minus 1. Okay, so that will give you, this is the formula for calculating money cost of capital. Again, if you want to calculate real cost of capital using the original formula of Fisher effects, then of course from this formula, from this original formula, you want to calculate, you want to make R the subject of the formula. You will notice that 1 plus I is disturbing 1 plus R, is disturbing 1 plus R, because you can't just move R away from that from that circle. So you have to first of all divide both sides. So this 1 plus I is disturbing 1 plus R. Therefore, you divide both sides by 1 plus I. So when you divide 1 plus M by 1 plus R, okay, that's what you have. So the one behind this R is what you are seeing there as minus 1. Therefore, real rate of return is calculated as 1 plus money cost of capital divided by 1 plus general inflation rate or minus 1. So this is the formula for calculating real rate of return or real cost of capital. Again, it is possible that examiner may want you to calculate general inflation rate. Maybe you are not given general inflation rate, but in the question, examiner will surely give to you money cost of capital and then the real cost of capital. So if that is the case, just the same way you calculated the money rate or real rate of return, then to get your general inflation rate is just 1 plus money rate of return divided by 1 plus real rate of return, all minus 1. So you get your answer for that. Okay, you get your answer for that. All right, so now to capital, as far as inflation is concerned, you must understand the general rules. There are 4 basic general rules, and additional 2 that I've added to it. So you can go through all of this, but again, the bottom line is that as far as inflation is concerned, whenever you want to appraise a project, the money cost of capital must be used for money cash flow. It's a given. Then rule number 2 is that real cost of capital must be used for real cash flows. Under no circumstance, number 3, under no circumstance should you use money cost of capital for real cash flow. Number 4, you cannot also use real cost of capital for money cash flow. All right. But specifically, if in a question you are given cash flows that are stated in year 1 prices or first year prices, then you should start inflating from year 2. Okay? You should start inflating from year 2. There's no book that will tell you this, but you have to know what to do at the right time. And that's why I have to include that caption. So whenever you are given cash flows that are stated in first year prices or year 1 prices, inflation should start from year 2. You should start inflating from year 2. Meaning that the first year price given to you is your base year price. So you don't inflate the base year price. You don't inflate the base year price. So it is that base year price you need to use to inflate for the subsequently. But for that year that you are given, okay, that year 1, you cannot inflate that year 1 because that's the base year price. So it is that year 1 you are going to use to So by the time you see live questions, you understand what I'm trying to communicate. Okay, so finally, let's talk about taxation, impact of taxation in capital budgeting. And once we are done with that, that will be end of today's class because my network is not stable, so it's frustrating. But in any case, let's move on. Let's talk about impact of taxation in investment appraisal. Now, whenever a company incurs qualifying capital expenditure on non-current assets like plant and machinery, equipment, motor vehicle, so the company So I was trying to explain impact of taxation. So like I said, the capital allowance is given in lieu of instead of a depreciation because companies use different methods to determine their depreciation. As a result, depreciation is a disallowable expenses for the purpose of taxation. However, whenever a company incurs qualifying capital expenditure on those non-current assets, the company is entitled to claim capital allowance. There are major three purposes or reasons for incorporating taxation in capital budgeting. One is to determine the tax liability. So the tax liability is the amount of tax the company will pay on the taxable profits. Okay, the tax liability the company will pay on the taxable profits. How do you then get the tax liability? Just multiply the company tax rates on the taxable profit. That's all. Then the second purpose of incorporating tax in investment appraisal is for the purpose of determining tax saved on capital allowance. Okay, for the purpose of determining tax saved on capital allowance. The essence of capital allowance is to reduce taxable profits and as well as the tax liability. That is the main reason of incorporating I believe it's because of some of you that joined us today. That's why we're having this issue. We hardly have issue of network. I don't know. It's just coincidence today. Okay, so those are the three purpose or reasons for incorporating tax in capital budgeting. I said number one is to determine tax liability. Then number two, to determine tax saved on capital allowance. Then number three, for the timing of the cash flow, that is when to pay the tax liability or to claim the capital allowance. Those are the three main reasons or purpose of incorporating tax in capital investments. Now, what are these various types of capital allowance? For the purpose of capital budgeting, there are four main types of capital allowance. One is initial allowance, two is annual allowance, three is balancing allowance, and the fourth one is balancing charge. What do you mean by initial allowance? Initial allowance is an allowance claimable once in the lifetime of the assets, which means that once you have claimed the initial allowance, you are not expected to claim again. How do you claim your initial allowance? Just multiply the initial allowance rates. Okay, you multiply the initial allowance rate on the cost of the assets. So that will give you the initial allowance. The annual allowance is allowance claimable every year until the final disposal of the assets. So to calculate the annual allowance, just multiply the annual allowance rates. Okay, you multiply the annual allowance rates. Subsequently, you can either, depending on how you want to determine how you are going to claim your capital allowance. Maybe it's on a straight line basis or on reducing balance basis. Whichever way, of course, they are pretty straightforward. So if it's on a straight line basis, that means the same amount of annual allowance you have in year one is what you are going to have all throughout the useful life of the project until the final disposal of the asset, when you are going to compare the tax written down value from the preceding year with the disposal value, whether you are going to have balancing allowance or balancing charge. So what do you mean by balancing allowance? The balancing allowance simply represents the difference between tax written down value and the disposal value. Okay, balancing allowance represents the difference between tax written down value and the disposal value. So, but it will be balancing allowance if the tax written down value from the preceding year is greater or higher than the sales proceed. Say, for example, you have a tax written down value. Okay, tax written down value of 200 million in year three. Okay, in year three, then in year four, which is the final year, this asset is disposed. This asset is disposed of for 150. The assets that are worth 200 million in the books is being disposed of at 150 million. Therefore, it means that the asset has been disposed lower than the actual value. So in that case, the difference of 50 is what the company will claim as balancing allowance. And that's why we are saying that balancing allowance will occur when the tax written down value from the preceding year is higher than the sales proceed or scrap value or sales receive value, trading value, whatever you want to call it, is the same thing. Then the second one is balancing charge. Again, balancing charge is the same thing as balancing allowance because they represent the difference between the tax written down value and the disposal value of the asset. However, it will be balancing charge if the tax written down value from the preceding year is lower than the sales proceed. Again, say for example, in year 5, in year 4, for example, let's use year 4. In year 4, you have a tax written down value. In year 4, you have a tax written down value of 500. Meanwhile, at the final year of the asset, which is year 5, the asset is disposed of. Okay, the asset is disposed of or for 600 million. You can see that means at disposal, the company has earned additional profit of 100 million, additional profit or gain of 100 million at disposal. That extra gain that the company has earned of 100,000 will be taxed in the hand of the company. That is what is called balancing charge. That is what is called balancing charge. Balancing charge is a taxable loss, whereas balancing allowance is a taxable profit, meaning that the company will claim balancing allowance, but balancing charge is the company that will pay tax on the difference. Okay, so that is how to, those are the types of capital allowance, and you must know what to do at the right time. But what is common? What is common is that, of course, at all time, whenever you want to determine your capital allowance or tax saved on the capital allowance, you must calculate your annual allowance. Then the second one you are going to calculate could either be balancing allowance or balancing charge, whichever one. So the question will tell you what you should do. All right. Then what are the methods of calculating capital allowance? I've mentioned it before. So there are basically 2 methods. There are many of them, but as far as capital budgeting is concerned, we focus on only 2, which is straight line depreciation method. So the straight line depreciation method is the same amount of capital allowance that will be claimed every year until the final disposal of the assets, when the company will need to compare the difference between the tax written down value and the sales proceed to arrive at either balancing allowance or balancing charge. So if say for example, you are given the cost of an asset to be, 150 million naira. Okay, the cost of this asset is 150 million naira, and the useful life of the asset is 3 years. Okay, useful life of 3 years. So you want to determine depreciation, you want to determine capital allowance. So, and then say for example, you are given the scrap value, of 50 million of scrap value. So all you need to do is to calculate annual depreciation, which is equal to the cost of the asset of 150 minus 50 divided by 3 years. Okay, divided by 3 years. So meaning that every year you are going to be whatever it is, that's 100 divided by 3. So every year, whatever the amount that you have, that's what you are going to be deducting from the tax written down value until the final disposal, when you are going to consider the scrap value. Okay, so that is basically how to determine. At times, if you are not given straight line, if you are not value, just divide the cost of the asset by the useful life. That's all. Okay, so that's it. Then for the reducing balancing basis, so the reducing balancing basis is just to, of course, every year you are going to be multiplying the percentage of the capital allowance on the tax written down value until the final disposal, when you are going to compare the tax written down value with the sales proceed to arrive at either balancing allowance or balancing charge. Okay, so those are the 2 methods of determining capital allowance. Okay, the 2 of them are common, so examiner can tell you can give it to you anyhow. Then the next area we want to discuss before we close the class is the timing of cash flow. That is, when to claim, when to pay tax liability, or when to claim capital allowance. So the tax will be paid. Tax can be paid in the current year, that is the year in which the profit is earned. Profit of year 1 will be taxed in year 1. Profit of year 2 will be taxed in year 2. That is in current year basis. However, it is also possible tax may be paid in arrears, or capital allowance may be claimed in arrears, meaning that after 1 year, so the profit of year 1 will be taxed in year 2. Profit of year 2 will be taxed in year 3. That is 1 year in arrears. All right, so you also need to know all of this. But the bottom line is that the capital allowance must follow the pattern of your tax liability. Capital allowance must follow the pattern of your tax liability. What do I mean by that? If tax liability is in the current year, capital allowance must also be in the current year. If your tax liability is in arrears, capital allowance must be in arrears. So watch out for that. So I've already told you the reasons for calculating capital allowance, which is to reduce taxable profits and the final reduction in tax liability for the purpose of incurring qualifying capital expenditure. The essence of capital allowance is to reduce tax you calculate tax saved on capital allowance. This is the format. You can use this format to calculate your tax saved on capital allowance. So whenever you want to calculate tax saved using this format, you are starting from year 0. From that year 0, you have the cost of the project. So whatever it is, the cost of the assets, put it there. Then allowance in the question. So if you have initial allowance in the question, so you are going to multiply initial allowance rates. Okay, you are going to multiply initial allowance rate with the cost of the assets. Whatever you have, you put it there. Then in that same year 1, you are going to multiply annual allowance rates. You multiply with the cost of the assets. So you add the two together, that will be the total capital allowance. Total capital allowance in year 1. So whatever I have here is what I will come and post here. So I will now less from the cost of the asset to have the tax written down value at the end of year 1. I will then move to year 2. In year 2, what I will have going forward will then be the annual allowance. So I will then multiply the annual allowance rates on the tax written down value. If the method is to use reducing balancing basis, if I'm using reducing balancing basis to calculate my capital allowance, so I will multiply annual allowance rate on the tax written down value, I will get this value there. I will then find the difference between the tax written down value and the annual allowance to get the tax written down value at the end of year 2. In this format, our assumption is that the asset has 3 years life. Therefore, at the final year, I need to compare the sales proceed with the tax written down value. So the difference between the tax written down value in the previous year in the somebody is making noise there. Sylvia. So the difference between the tax written down value from the preceding year and the sales proceed, okay, we give either balancing allowance or balancing charge. The one in brackets is called balancing charge. Okay, the other one is called balancing allowance. So if I want to, of course, if I want to use capital allowance to reduce my tax liability, so before I calculate tax liability, I will then first thing first, say for example, I want to calculate tax liability. So I would then say tax liability, okay, tax liabilities. Say, for example, this project has 3 years life, okay? So I would then pick the profits for each year. Profit for each year. First thing first, before I calculate my tax liability, I have to deduct capital allowance. So the capital allowance I've computed for each year. Let me remove all of this. So this is the capital allowance for year 1. This is capital allowance. Let me use capital allowance for year 1, capital allowance for year 2, capital allowance for year 3. Whatever I've calculated as my capital allowance, I will come and deduct first. I will deduct from my profit before I determine tax liability. So the difference will then be the taxable profits. This is taxable. I need to multiply the company tax rate on it. So I will then calculate my tax liability. Tax at whatever percentage, say you have 30% tax. So I would then say 30% on the profit for each year. So whatever it is, put it there. So this is the one I'm going to recognize whenever I want to calculate my I want to calculate NPV or whatever technique that I want to use. All right. So that is using capital allowance to reduce tax liability. In this case, I've used this capital allowance. Okay. I've used this capital allowance to reduce my tax liability. But if I want to use tax saved on capital allowance to reduce my tax liability, then in that case, what I need to do is to multiply the company tax rates on the capital allowance for each year. So I will multiply company tax rates on capital allowance of year one. That is, say, for example, the company tax rate is 30%. I'll say 30% of the capital allowance in year one. I'll put it here. 30% of capital allowance in year two. I'll put it here. 30% of capital allowance in year three. I'll put it here. This could be positive or negative, depending on whether it is balancing allowance or balancing charge. So at the end of the day, I might decide to confirm. If I want to confirm whether my total tax saved is correct, whether what I've claimed is correct, then I can use a formula to do that. Okay. So if you want to confirm whether your total tax saved is correct, so this is the formula you are supposed to use. That is, total tax saved is equal to the cost of the asset minus the scrap value multiplied by company tax rates. So this will tell you that whatever you have calculated here must be equal to whatever you get if you use this formula. Okay, whatever you get if you use this formula, that's the implication. So that will help you to know whether you have gone or you have claimed above what you are supposed to claim, or you have claimed below what you are supposed to claim. All right. So that is for that. So you can read more. So finally, let's talk about, okay, I did not give a format here. So let's talk about, let me give you a format you are supposed to use whenever you want to compute NPV or internal rate of return. Let me look for a bigger space. Let me look for a bigger space to do that. Hopefully I will have, okay, I have one here. Let me show you. Whenever you want to compute NPV, in this question, if you are given multiple variables, in the question you have selling price, you have variable cost, you have inflation, you have taxation, you have scrap value, you have working capital, you have multiple variables. In that case, you cannot use the small table for calculating NPV, the one I showed you earlier today when I was explaining net present value. So you can't use that table to calculate your NPV. Rather, you are supposed to use the columnar format. Okay? You are supposed to use the columnar format, okay, to compute your NPV. NPV, using, this is the format that you're supposed to use. Say, for example, this project has 3 years life. So let me just say calculating net present value. So you want to calculate NPV. So we're assuming that this project has 3 years life. Therefore, year 0, year 1, year 2, year 3. Then you can create additional column for workings. Okay. Year 1, in year 0, rather. That, of course, that's when you have the initial outlay, but the first item will be the sales value. How do you determine the sales value? First thing first, you go to the question. You pick the selling price. You go back to the question, is there any inflation for selling price, or is inflation going to impact the selling price? If yes, first thing first, inflate the selling price. Once you inflate the selling price, you multiply with number of units sold. You get your total sales. Then you come and post. You post your sales. This may be for working one. You also go back to the question, if you are given variable cost. If yes, then you need to inflate the variable cost. If there's inflation, then you multiply with number of units produced. So variable cost. So whatever the amount that you have calculated, come and post. That's working number 2. If you deduct that from 6, then you go back to the question you need to confirm. If you are given direct fixed cost, incremental fixed cost, specific fixed cost, or attributable fixed cost. Provided the fixed cost is relevant, just come and post. So let's say incremental fixed cost. Again, I will go back to the question. If you have inflation on fixed cost, if you have inflation, just inflate the fixed cost, then you post. It's a cash outflow. If you like, you can do working for that as well. If you like, you can just use your calculator and get your inflated fixed cost. Okay, it's not compulsory. You must do working for that one because it's not related to number of units. So there is no need to be sweating on that. Then after this, the next thing the answer you are going to get will be the taxable profits. Okay, to be profit or loss. So it is at this point, immediately after once the project has generated profits, you need to pay tax. So to pay tax, we depend on, I will then go back to the question, how am I going to pay tax? Is my tax in the current year or in arrears? Based on this format, our assumption is that tax will be paid in the current year. Therefore, I will then say tax at the company tax rates. So I will multiply the company tax rates on the taxable profits. So I'll multiply the company tax rate on the taxable profits. Now, at this point, just multiply on the profits, you get this. Now, it all depends on whether you want to use capital allowance to reduce your tax liability, or you want to use tax saved on capital allowance to reduce your tax liability. Whichever one you want to, you are going to get the same answer. But the bottom line is that based on this format, our assumption is that we are going to use tax saved on capital allowance to reduce tax liability. Therefore, I need to go and calculate tax saved. Tax saved on capital allowance. So we are going to use the same format I've shown you previously. So just go and calculate your tax saved on capital allowance, come and post. Okay, so that's working number 4. After this, I need to consider if there is scrap value or sales proceed in the question. So we are okay. So scrap value generally will occur at the final year, which is year 3 in this case. Then I need to consider initial outlay. So initial outlay will be in year 0. Whatever the amount, it's a cash outflow. Then I need to consider if there is working capital. So our explanation on whether it is a one-off working capital or incremental working capital. Based on this format, our assumption is that we have a one-off working capital that occurs in year 1. Therefore, we treat it as cash outflow in year 0. Then at the end of the useful life, we recover the working capital. Say we have working number 5. So at this point, we need to determine the net cash flow. Okay, that's the net cash flow. So after the net cash flow, at this net cash flow, you can use any technique to appraise the project. You can use payback period, you can use NPV, you can use internal rate of return. The only method that you cannot use is accounting rate of return because this is net cash flow. Accounting rate of return makes use of accounting profits. So you cannot use net cash flow to compute accounting rate of return. So I would then say discount factor at whatever percentage that is given, of capital that is given for year 1. For year 0 is generally 1. I will do for discount factor for year 1, year 2, year 3. Then at the end of the day, I will get the present value of cash inflow and then present value of cash outflow. This is the present value. So I will add up all the present value of cash inflow. I will add up all the present value of cash inflow, okay? Then I will less present value of cash outflow. The difference will be either positive or negative NPV. This is the net present value. This is how to calculate net present value. So this is the format you are expected to use to compute NPV whenever you have multiple variables. Multiple variables in the sense that we have selling price, you have selling a variable cost, you have incremental attributable specific fixed cost, you have taxation, you have inflation, you have scrap value, you have so many variables in the question. In that case, columnar format is the best method to compute your NPV. It will make life very easy for you. So that is the end of today's class. Let me hear from you. So in our next class, all what we'll be doing are just calculations. So let me know if you have any question for me before we close the class. Talk to me.
Hello, sir.
Yes, Yusuf, go ahead.
Please help us share the format you just did.
Okay. Okay. What I will do is that, I'm not using I'm not using the working notes. I'm using the material. However, I will ensure that you get the video tomorrow. All right. Because this is a combined class, I have to ensure before all those my students in VI started dealing with me. You guys online students are very gentle. So yeah, I will ensure you get the video tomorrow by the grace of God. All right.
All right, sir. Thank you, sir.
You're welcome. Abdulhamid, you wanted to say something?
Not really. I just want to thank you for the effort, sir.
You're welcome. Come on, where is Abdulatif? This guy has been missing my class for a while now. I hope he's anyway. I will call him. Tom Grace, I did not hear your voice tonight. What happened? Amarachi. Kunle, you too. You did not talk tonight.
Evening, sir.
How are you? Lola. All right then. So good night to you all. We'll see you next time by the grace of God. And for those of you, the VI students, we are going to meet on Saturday by the grace of God when we are going to complete the topic, and that will be it. And then on Monday, again, by the grace of God, we meet online to end the diet. Thank you guys for your time and patience because of the glitches in my network. I hope that next time it will be fluent and smooth. We are going to have a smooth class. Okay, thank you once again. Good night, everyone. Bye-bye.
Yes, sir. Thank you, sir. Good night.
Good night.